In this session, I'm going to talk about profitability analysis. We're going to talk about some of the stuff that you're probably already pretty familiar with, the basic measures of profitability, and we're going to spend most of our time talking about these more sophisticated measures and this modified DuPont analysis here. So let's get started. So we think about a basic income statement in its simplest form. Sales minus cost of goods sold gives us gross margin. Subtract off operating expenses, things like depreciation, selling, general, and admin, gives us operating income, also called EBIT, earnings before interest and tax. Then other income and expense, interest income, non-core operations, those kind of things, to earnings before tax, subtract off taxes, and we get to net income, the bottom line. Now, as you've seen before in other courses, Fin 201 and accounting courses, the basic profitability metrics, and these are very useful, we use them all the time: gross profit margin, gross profit divided by sales; operating profit margin, operating income, EBIT, divided by sales; net profit margin, net income, divided by sales; and then return on assets. I don't have total assets and total equity here, but net income divided by total assets equals return on assets, and net income divided by total equity equals ROE. And so those are all pretty familiar to you, I am sure. What we want to talk about is this more sophisticated measure called return on net operating assets, RNOA. And RNOA is the ratio of two important numbers. This thing, net operating profit after tax, universally referred to as NOPAT, divided by average NOA. And I'm going to follow the textbook using an average NOA approach. As I will talk about here later on, sometimes we can use end of year or different measures of NOA, but we're going to use average NOA here. So what is NOPAT? NOPAT is the profit the firm would have if it had nothing below the operating income, operating earnings, except just taxes. So if it had no interest expense, no interest income, no other non-operating stuff that's there, then NOPAT would be your net income. It is a measure of the core earnings, and that's important because generally we're looking to a company's core earnings to decide its value. And if a company is making money only because they are selling off other assets and have big gains on disposal or other kinds of things that are below operating earnings, that's not a good thing that's here. So NOPAT is earnings before interest and tax, operating earnings, times 1 minus the tax rate. And one of the things, and we'll talk about this many times, one of the things we're notorious for in finance is the same thing is called 4 or 5 things. And so operating earnings, income from operations, earnings before interest and tax, all the same thing from here. Where do we get the tax rate? What we want is the statutory tax rate. And the statutory tax rate is the rate before adjustments for deferred taxes. And where does it show up? Well, in every set of financial statements, there's notes to the financial statement, and there'll be a note called income taxes, and it will show you what, typically in a little table, what the statutory rate is. But the easy thing to do is go to the income statement, and the income statement, as we just went through, will say earnings before tax minus taxes, net income. And so if you take the provision for income taxes, which is that rate below earnings before tax, and divide it by the number that's typically right above it, that will give you this statutory rate. A fair question to ask at this point is this what they really pay in cash taxes? And the answer is no, because of the impact of deferred tax. And we'll go through some deferred tax stuff later in the class. It gets into a little bit of finance theory about why we want the statutory rate, and you'll see some analysts who will use the cash tax rate. We're going to use the statutory rate because the leverage effects are not included when the cash tax rate interest tax shield gets in there. As I say, this kind of gets a bit into finance theory a little farther than we need to. So we're going to use the statutory tax rate from here. So where do we get net operating assets? And this is a different concept. Net operating assets are the total assets less those excess assets, not necessary to run the business, less operating liabilities. So total assets less excess assets less operating liabilities. So what are excess assets? Cash is the big one. Marketable securities, which is a near cash item. If the company has some discontinued operations that they're trying to sell off, those would be in there. Uh, assets that they don't need to run the business from here. Most of the time it's cash, some of the times it's marketable securities, and occasionally it's some of these other things. A fair question to ask is, don't you need some cash to operate the business? And of course the answer is, yeah, you do. But by convention, we subtract all of the cash as an excess asset from there. That's just how it is done. It's hard to estimate what the minimum cash levels are, and so that's the convention that's there. What are operating liabilities? Operating liabilities are all of those that occur in the regular course of business from here. And so accounts payable, accruals, those kind of things. The items that are not operating liabilities are interest-bearing debt. So you have two kinds of liabilities. You have operating liabilities and you have interest-bearing debt. Those are the two. It's either one or the other. And we'll go through this in an example. Average NOA, take the beginning NOA, the ending NOA, divided by 2. So this year's minus and plus last year's divide by 2, because last year's ending is this year's beginning. Now you'll see some variations. The most common variation you will see is using only the ending net operating assets. And that's often convenient because we don't have the prior one, or we want to have more years that we can calculate. Average, calculating the beginning and the end divided by 2 gets you somewhat of an average, but if you have a business that has a lot of cyclical, for example, Toys R Us with its inventory that goes from the end of January when they starts building up, and by mid-fall is gigantic, and then drops back to very, very small. So if you have a big, the end of the year and the beginning of the year don't capture the average amount of assets at a company like Toys R Us. So you might see average quarterly NOA that's there. A very key thing, and we'll talk about this over and over this semester, is make sure you're making comparisons that are based on the same calculations. If one's average beginning and ending divided by 2, and the other's average quarterly, and the other's end, you're going to get different answers, not because of different performance, but because you're using different numbers. Very important that our comparisons be on an equal basis from there. Okay, enough of the formulas for now. We'll be back to more formulas. Let's look at a company. Here's one I'm pretty sure you know. Alphabet is the parent company recently created of Google. We're all using their products a variety of ways, their search engines from here. And so this is from Form 10K. Every company, as we talked about early on, has to file public disclosure statements, typically 70, 80, 100 or more pages of stuff. And so this information I've taken from Alphabet. That's here. I want to calculate the statutory tax rate. So I go to income before income taxes, and I have the provision for income taxes, and so I simply divide the amount of taxes that in their provision, divide it by the number right above it, and I get a tax rate of 16.81%. Straightforward. Now I want NOPAT. NOPAT is income from operations, EBIT, times 1 minus the tax rate. In 2015, Alphabet had NOPAT, net operating profit after tax, of 16,106. These are in millions, so you add 6 zeros, that's $16 billion, pretty sizable amount of money. Now let's do the components of net operating assets that are here. Net operating assets are total assets, so we've got our total assets here, less excess assets. When we start looking here, they have cash and they have marketable securities. They've added them together for us very conveniently from here. So we're going to take that. We look down the rest of them here. Non-marketable investments, those are not included because those are investments in other companies. All this other stuff is regular stuff, so we're not going to subtract that, not excess. And then we subtract the operating liabilities. There are liabilities are either interest-bearing debt or an operating liability. And so if I look down here, if I look at the other, what's interest-bearing debt? Well, they have short-term debt and they have long-term debt. Now, some companies will have more items than this. Uh, some companies will only have one item. Maybe some will have none. But everything else that's here, accounts payable, accrued compensation, accrued expenses, accrued revenue share, security lending payable, deferred revenue, income taxes payable, deferred revenue, non-current income taxes, non-current deferred income taxes, all are operating liabilities. Now note, I've got a question mark down here. Other long-term liabilities, when you're doing this for your company on your project, you want to go into the notes to the financial statements and take a look and see what this thing is. If it looks like interest-bearing debt, loans, notes payable to somebody, then we should include it not as an operating liability, but as interest-bearing debt. In this case, it didn't look like that. It's just other kinds of kind of a miscellaneous category. So I've included it as an operating liability. So my measurement then, if I take my calculations and just exactly what I did here before, total assets less the cash and the marketable securities, less the line of all those things that they're line items, we get to net operating assets, and I've got them 2014, 2015, so average 48,594. Return on net operating assets, we had net operating profit of 16,106, and we had average NOAs of 48,594. We get a return on net operating assets of 33.14%. Is that good? Is that bad? And the answer is, we don't know, not at this point. Ratios are only meaningful in comparisons. Another really important thing, that you can compare that over time. If you know this thing is increasing, then that's probably a positive sign. If it's decreasing, it's a negative sign. If you know that Google's competitors all have a higher number or lower number, that tells you something about whether this is a good or bad number. But for now, it is just a number that we'll look at later on from here. Now, in rare cases, net operating assets can actually be negative. Take a look at this company I pulled up. Now, this company has got 300, this is 2016, they got it in the opposite order this time. So 321, this also is in millions, so $321 billion total assets. But they've got, between the two here, we've got 20, 46, 56, 60, 67, $67 billion of cash and cash equivalents. Plus, you have long-term marketable securities of another 170. So we're talking a total here of about 240 of this 320 is in cash or near cash, excess assets. And then they've got a stack of operating liabilities that are down here, all these things that are red lined. And so if you take the pieces of them, you actually have net operating assets that are negative. How can that be? Who is this company? Company that you actually know pretty well. This is Apple. And when we think of Apple, we often say, well, they make iPhones and they make Macs and they make all this cool stuff. The reality is that they sell that stuff, but they really don't make it. They contract that primarily to Chinese manufacturers. They design it. They have huge research and development, and they design, but they don't own any manufacturing plants. And in fact, in many cases, if you order online, they never touch that inventory. That inventory comes from a plant in China directly to you by a FedEx or some other carrier, and they never touch the inventory. They just get the profit from it. So it's a really good business model. They have all of their assets and more are financed by their operating liabilities that basically are free to them. So it's a very good business model. No wonder they're doing so well. I want to swap to talking about the DuPont equations from here. That this one you know. If you don't, you go look it up, because this is really important. We did this in Fin 201. You're going to see it all the way through your career. You're certainly going to see it in Business 400 from here. Return on equity, return on book equity, the counting measure of equity, is the profit margin, net profit divided by sales, times total asset turnover, sales divided by total assets, times the equity multiplier, total assets over total equity. And the equity multiplier is also equal to 1 plus the debt equity ratio that's there. Widely used. You're going to use it. We're going to use it. It is a really useful, very simple tool to say, I know my ROE has gone down this year. What happened? Am I less profitable? My sales have sales per dollar of assets declined. Have I changed my leverage ratios, or in comparison to another company? There are some problems with it. It's a great tool, but it's a simplistic tool. All profits are treated the same, whether they're core or non-core. All assets are treated the same, whether they're needed in the business or not, and all liabilities are treated the same, whether they're an operating liability or interest-bearing debt. And so we're going to get a little more specific here. The modified addresses these limitations, doesn't distinguish between these characteristics, and as a result, true performance can be masked by differences in financing strategies and particularly cash holdings. This is the time, this tool is one to have in your back pocket when you're analyzing a company that has a lot of cash. Companies like Apple, and in this case Google as well, that's here. So it helps us in this piece from here. It's a different concept that gets come into line here, and this is this idea of net debt. So we exclude cash from required assets. This modified model treats cash as negative debt. So if you have cash, you not only don't owe anybody, you got excess money here, money that's not needed necessarily to run the business. And so net debt is interest-bearing debt, the stuff that's not operating liabilities, less cash. And by cash, we're including marketable securities and the other kinds of pieces that are in there, cash and near cash. Net interest is interest expense minus interest income. And so we have an adjusted cost of debt, which is net interest times 1 minus the tax rate divided by net debt. And so we redefine our cost of debt that's here. This complete modified DuPont model looks like this. Return on equity, which is the same number we were using before in the traditional model, is now return on net operating assets, which we have calculated, plus this spread, which is return on net operating assets minus our adjusted cost of debt. And that whole piece in the square brackets multiplied by this net debt over equity, a debt equity ratio, but adjusted for cash holdings from here. So let's look at how that can work. So if I go back to Alphabet here, and I look at their net debt, they have the short-term debt that we picked up here before, each one of these, and then they have these big cash holdings and near cash holdings that they have before. So their net debt is in fact negative here. They have more cash equivalents of marketable securities than they do outstanding debt. So they actually have substantial excess cash, far in excess of their debt. They have average net debt that is negative. So it's a negative $63 billion from here. Their equity, pull the bottom of the equity, and we always want to be looking at the total equity numbers that are there. So their average equity, the two numbers divided by 2, 112. And now we can do these calculations. So net interest expense, the 291 here, often called other income and expense, doesn't always have to say interest. And I adjusted it by that large negative net debt that we had back there, and that gives us a negative 0.38% here. So I now have going back through my DuPont, or my modified DuPont analysis, I come down to RNOA, which was the calculation that we did before. The spread is RNOA 33.14 plus, minus the 0.38, but minus times a minus is a plus, so that's the 33.53 from here, times financial leverage, so that's they have negative debt divided by positive equity, so this financial leverage thing is negative, and then the spread times the financial leverage is negative, and we subtract that, and this brings us down to 14.15%, which is their return on equity. So here's the formula here for your review. And so this is a very different kind of look that's here. So I want to compare this to traditional DuPont. If you looked at traditional DuPont, it says that their return on assets is 11.44%, made up of healthy profit margin of 21% and a much smaller total asset turnover. Now, if we focus on return on net operating assets, so they have a lot of excess cash, we correct for the excess cash and we correct for their operating liabilities, their return on their net operating assets is much, much higher. But when I look at the traditional model, it suggests that their use of leverage, all of their liabilities, actually gives them a higher ROE because of this use of leverage. This model shows something very differently. If they could earn their return on net operating assets, they'd have a return of 33%. Their use of leverage, and particularly their high cash balances, are actually hurting their shareholders, and their return on equity is much lower than the return on net operating assets because of the use or the holding of all of this cash from here. Okay, so there's the end of this piece. A lot of calculations, something you're going to want to go through. We're going to go through a detailed exercise in class, but at a minimum, you should be comfortable with calculating return on net operating assets, know about NOPAT and NOA, which you're going to see over and over again, the traditional one, which you should come into this knowing, and then the modified one. I look forward to seeing you in